Good morning, and welcome to the Financial Pillars All About the Money podcast presented by Our Neutral Voices Media. Our show is all about helping our audience understand money, mindsets, and tap into the economic knowledge that builds financially secure individuals, families, and communities. So, whether you're tuning into our show to learn about budgeting, building credit, investing, or starting your own business, we're here to break down the knowledge in a real and relatable way. I'm Ryan Leopard, private banker with Star Financial Bank.
JJ Foster, Lake City Bank.
Terrence Bush, personal banker at Star Financial Bank.
Oh, big news for Terrence over there now. No more universal banker.
No more universul business banker.
Right. So not only are we a team here, we're a team at Star also.
Yes, sir.
I feel sandwiched up in here.
Not going to go there.
Yeah.
Welcome, Terrence. It's awesome to have you at Star as well.
Thank you.
Too.
Thank you.
So, a couple weeks ago, actually, who's going to lead us off with the prayer? Sorry.
I got you. I'll take it. All right, let's bow our heads and close our eyes. Dear Heavenly Father, thank you so much for allowing us to get here today. Thank you so much for the slightly warmer weather than what we've experienced in the past couple of days. It's made the drive around the city a lot easier, and I'm thankful that everybody was able to get here safely. I ask that you allow us to help us nurture our audience as we give them information how they can better protect themselves financially for the future and for their retirement and for the rest of their family. In your name I pray. In Jesus' name, amen.
Amen.
Amen to that weather.
You got that? I was going to say, heat wave. You're right.
Yeah. Heat wave at 30, 40 degrees. Yeah.
Hey, we take it.
So, a couple weeks ago, we had our friends from DR Financial, Mark Ellington here, kind of talk to us a little bit about investing, right? But the conversation was from kind of a financial advisor standpoint. So kind of made me start thinking, let's go back a little bit because not everybody is necessarily ready, in my opinion, for a financial advisor. So investing 101, investing for beginners. I kind of prepared some of this information on behalf of JA. I was going to go talk to some classes at Snyder High School, so I kind of already had this information. So love to kind of talk to our audience out there. If you're not investing, you don't really know much about investing, this is kind of some starting points with it, right?
Gotcha. Yes, sir.
So really, in my opinion, investing is kind of preparing to know when are you ready to invest, right? So preparing your finances, right? What does that kind of mean when
It means, I think, you hit the nail on the head. If you're not quite ready, you're paying bills and you're talking about investing, but I got the day to day. How can, how can I invest money when I have to put food on the table? But the first thing, I talk about is just, handling your debt, pay off some of your high interest loans, get your emergency fund built up 3 to 6 months, and then, establish a budget. And if your budget allows that you have, some discretionary funds or some extra money, now you might want to look into how can you make that grow.
Yeah, I think that budget is the key thing because if you don't have that extra money, should you be investing it, right? Because really, investing, there's a chance we lose the money. Right, you may not make money, you could lose money there. So, touching on real quick on like paying off the high interest rate debt you have. If you do have debt out there, let's say credit card debt, and you're making monthly payments on that at 20%, 25%. Does it make sense for you to take your extra money and invest it when you could make a 6-7% return, maybe higher, but typical return? Or does it make sense to let's get our debt at 25% interest? Financially wise, it probably makes more sense to pay off that debt, and then once we have that extra money, that extra income, we're now in position to think about investing, right?
Correct. That's what, life is about options. You're right. And you look at it and you have to weigh what's in your favor.
Yep. So once we kind of prepared our finances, then we want to kind of define our goals. What does that look like, Terrence?
When we are defining our goals, of course, there are short-term goals, long-term goals, just depending on where you are at currently financially. Short-term goal can be anywhere between paying off a credit card or, saving up enough to get a new pair of shoes, getting a new jacket, outfit, depending on whatever you are specifically looking for, of course. Short-term goals also include going on vacations if you want to save up to take a trip to the Bahamas or go to Hawaii, just to do something simple, I would say. In terms of long-term goals, of course, I would say we're looking at things that are going to be tying you down for a while, things that you have to plan for X amount of years. I would say maybe 5 to 7 plus years. In terms of maybe potentially getting ready to buy a house, preparing for your retirement, of course. If you have family that you're potentially looking to set up financially in terms of college funds, things like that. It just depends on what your specific goals are, of course. Especially if we consider buying a house, of course, you have to first find a house, consider how much a down payment would be, how much your monthly payment would be, of course. So again, to hit on that budget, of course, that is everything that does need to be taken into consideration before moving forward with short-term and long-term goals as well. Of course.
So real quick, jumping in there, when you mentioned the house, because some people could be a short-term goal, some people I think it could be a long-term goal with it. But that's an interesting one because there's a couple different mindsets that come to mind. Is if somebody's out there saying, "Hey, I want to buy a house, but I need to come up with this down payment. If I got X amount of dollars right now, let's say I got $5,000. If I invest it, I can grow it. Maybe I can get into that house sooner, right, and have that down payment." But really, my opinion, anytime you go into investment, you want to go into investment with a long-term goal, and probably 3 to 5 years is not long-term investing wise. Why? Because your investments can go up and they go down.
Absolutely.
And house should be a priority, right? So
Yes.
you don't want to risk that money. Put in something safe. And there's some, safe investments that we'll talk about, CDs, savings that grow a little bit of interest. But ultimately, me personally, I don't know if that would be the right mindset of let me invest my $5,000 in the stock market, hoping to grow it to get the down payment on my house. Right?
Yeah, and that also hits back with the preparing your finances as well. A term that I've heard myself is financial freedom, of course. With that being said, of course, you have a healthy safety net just in case you lose your job, you lose income, 3 to 6 months of your income saved up to be able to take care of all your obligations and bills and still be able to, stay afloat. Of course, even with that being said, on top of financial freedom, getting out of debt completely so that your finances are able to work harder for you because you don't have any extra obligations out there. Once I feel those 2 steps have been met, of course, that's when you can start looking at those long-term goals. Of course, if you plan on buying a house, it'll be easier for you to put more of your income towards paying off that house, of course, building the equity in that home as well, too. Of course, depending on where you are personally. For myself, I would want to be financially free, of course, make sure that safety net is already there. Potentially may even build it up to 6 months to a year just to have that extra safety net. And then, of course, potentially buy a large asset like the house, of course, get that paid off, potentially build that equity in the house, and then be able to access that equity. And then I would use that to potentially invest. But that is just my personal opinion on how I would go about that.
Yeah. And when it comes to buying a house and down payment, to put that in perspective, you're a resident mortgage guy here. What kind of percentage would somebody have in mind that they usually need for a down payment?
We got first-time home buyers, 3% potentially. I know everybody, if you don't want PMI, 20%, but 3 to 5% is safe to say.
Typical.
Yes, sir.
Gotcha.
Yes, sir. Now, hold on. Before you move, I want to, downshift a little bit because we talked about investing for beginners, and you let it off. You said you got to thinking because you were in JA. Mm-hmm. Everything that we talked about right now so far has been about adult situations, preparing your budgets, paying off debt for home ownership. I want to focus a little, on the youth, because at the end of the day, when we're talking about investing, a lot of youth don't have any of these problems. Mm-hmm. If I'm a kid and I'm working, I've got a job, let's say I'm making $300 a week. My parents are paying everything. I don't have any expenses, any bills. When we talk about discretionary income or money that you can play with, as a young person, I've got these funds, discretionary funds, that my risk tolerance is a little different than my parents'. And I've got time on my side. So when we're talking about, and we will get off of some of these other, these types of investments, you got time on your side. So you're talking money to grow. And you even mentioned it when you talked about when you're investing and not touching your money, it's more of a long term. So who better than a teenager? Mm-hmm. So I just wanted, make sure that, we emphasize that.
Yeah, that's what we were talking about a little bit beforehand. My mindset around this is just investing for beginners, whether that's somebody young, which is usually the case, but there's also a lot of older people. When I say old, 20s, 30s, that haven't even begun. They haven't begun contributing to a 401k or anything. You don't really know anything about investing on there. I'm going to challenge you a little bit on the young people with the debt. I had debt at 18.
You did. Hey, trust and believe. I got young people who
all that stuff.
Correct, who are contributors to the household. But I'm just saying there are some that are at that point where, hey, their money is their money. But there are some, you're exactly right, that could have debt and are key contributors.
So going back to and finishing up on the defining your goals, one thing, risk tolerance as well. So kind of what that means is when you're thinking about investing, what kind of investing you should do is what is your risk tolerance? Are you somebody that, you're it's going to kill you if you lose $5? Or are you somebody that's I would say maybe a gambler, right? It's not going to affect you to watch your money go up and down as that, right? Because that's going to really tell you what kind of investing you should be doing.
Right. And with that being said, I know typically the rule of thumb is typically for the younger ages is typically to invest more aggressively because you have the years to potentially watch the market go up and down and potentially, of course, get a greater return at the end of the day. But if you are typically, from the like older age groups, of course, typically they like you to invest in like, annuities, things that are fixed, for a fact where there's not a lot of risk to be a little bit more conservative, just in case something does happen, you aren't going to suffer a huge loss.
Yeah. So if we're talking about traditional investing in the stock market, mutual funds, things like that, yes, the younger you are, there's going to be ups and downs. But history has proven the longer you stay in it, you're going to make money in it. But it's just when you're younger, you can survive those downs. When you're older, you have the money, you're close to retirement age. Well, you want to scale back on what your risk is involved because you may not have that time to make up those losses before you actually need to kind of touch those funds, right? So that's kind of the thought process behind that. So we talked about preparing our finances. Next step was defining our goals. So once we've done that, now it's time to kind of choose the right type of account, right? And when we're talking about this is more traditional investing, which is once again, mutual funds, stock markets, things like that. So what type of accounts would we look at doing when we're trying to decide what would be best for us?
That's a
Let me
great
jump
question.
in
That's a great question.
So first one, just standard brokerage account, right? So to your point, I'm 18 years old. I can now legally do some investing. I don't have house is off in the future. I don't really have any bills or anything like that. I got $500 extra a week that I can play with. What do I want to do? I want to open a brokerage account. Okay. And each paycheck, I'm going to kind of put $500 in there and then kind of play, stocks, mutual funds, stuff like that. As we move on here, we'll kind of describe what stocks are, what mutual funds are for our listeners out there. But a brokerage account is a standard investment account that offers flexibility for various financial goals beyond retirement, right? It's not sitting there. It's not the tax sheltered account for retirement. It's more or less you're buying, you're selling, you're taking losses, you're realizing gains. Taxes are going to have to be factored in there. You're profiting from this as you're buying and selling. Then that's something you're going to have to realize on your taxes each year. Okay. So you got short-term gains versus long-term gains in a brokerage account. Short-term gains is if you buy stock, mutual fund, and let's say you see a profit or even a loss and you sell that within the first 12 months, that's a short-term gain. Short-term gains, the difference is how you're taxed. Short-term gains are taxed as your income is. So whatever tax bracket your income is at, let's say you're in the 22% tax bracket, you're paying 22% on those gains, right?
Gotcha.
Now, long-term gains, if you've held that position for longer than 12 months, well, then there's a set rate for long-term, okay? I believe it's 15%. I'm not a tax consultant, so don't go off of that. But yeah, it's a much lower rate because you've held it for longer than 12 months in that position. So that's something for you to know when you're out there. A lot of people want to buy and sell. Understand that that's going to make a difference in how much you get to keep of that when it comes to taxes. Okay. IRA. What's an IRA?
Individualized or individual retirement account.
Okay.
IRA, Roth IRA, and regular IRA. See, I do know that much.
You know that one? Can you tell me the difference between Roth and traditional?
Pre-tax and after-tax.
Okay.
Is that correct? The Roth is after-tax. That's long-term, and you can actually, at what certain age, can pull against it and whatnot. And again, I'm not the financial advisor, so again, my thoughts are not my own. Or what's the disclaimer?
My thoughts are mine and my own.
There we go. There we go.
So let's go ahead and give that disclaimer now as well too.
I was going to say, yes.
Financial planners. We are not financial advisors. The information on here can be found online, and has been gained through just personal experience through doing that. If you are looking at doing this, please do your own research as well as, you can consult with a financial advisor when it comes to some of this stuff as well.
There we go.
But so individual retirement accounts, that's something that if you're planning not for today, not, you don't want to use these funds immediately. It's more for you want to set yourself up for retirement when you're no longer working. IRA, traditional IRA is an individual retirement account, which is pre-tax money. So any contributions made to that is on a pre-tax basis. Okay. That means you have not paid taxes on those funds yet. So as you invest those and those investments grow, when you go to take them out, you're paying taxes on those funds because they have not yet been taxed. And then in that, there is an age demographic. Like if you touch it before the age of 59 and a half, because it is for retirement, you're paying an additional 10% penalty plus the taxes on there. So really it's an account that's best served for somebody who's not touching it, wants to sit there and grow, and those funds are really earmarked for retirement. Roth IRA. Roth IRA is a little bit different. They're after taxed funds. So any contribution you made, you've already been taxed on. I'm not going to go into all the specifics on that because there gets to different time periods of when it may grow tax deferred or no tax at all. I'm not well versed in the Roth IRA to speak educated on that, but it is an option out there as well for you. Then we come to workplace retirement plans, otherwise known as
401k.
401k. Okay, so a lot of times people think 401k is just a retirement plan, when really it's a work-sponsored retirement plan. It's a plan that your job offers you as one of the benefits for working there, right? Typically, a benefit of that is an employee match, which means that if you contribute a certain amount, your company may match 100% of that. They may match 50% of that. They may match 25, whatever it is, they may do a match of that. So it's kind of a way for you to get some extra funds in there by contributing to that, right?
You said 50%. Where you working at?
The different places have
Okay.
different things. Yes, I didn't say that's what I was getting. Yes, but that is, yeah. So because some places will do that as a benefit, like if you're only there for the first 2 years, they might match up to 25%. After a few years, you might match 50%. After you've been there for 5 years, they may match 100% of what you're doing, right?
Wow.
So there's different contributions based upon your employer for it. So,
Gotcha.
but realistically, and then once again, this is just my opinion. Usually, right, if you're working, your company offers you a 401k plan and they have a match on that, that's usually a lot of times where you want to start, right? Set up for retirement, but if you're getting that free money, that extra money from your employer coming in there, why not contribute to that first?
Yeah.
Right? But at the same time is if your plan is not for retirement, your plan is, hey, I want to be able to utilize these and touch these funds, well, then maybe you don't do the work 401k, it comes in your paycheck, you're realizing taxes on it, but then you take that extra money and you're putting into a brokerage account and it's growing through there as you do your own investing, right?
Correct. And I know, a lot of places that get creative now. It used to be kind of like you said, that was investing at its bare minimum. You put money in there, had modest growth level, but then as a company started evolving, it really got off into more or less like investing. What is your risk tolerance? And they'll talk to you as far as what type of investments, how do you want to diversify, your 401k. So
yeah, and one before we move on from the 401ks, I want to throw this out there too. So if you are contributing to a 401k, and let's say you leave that job, right? Because that is a plan sponsored by your current employer, you do have a couple options, right? You can take possession of that 401k and move it over into your own IRA. You open up your own IRA account, you move the funds over there. Therefore, it's still under that tax sheltered banner, right? You didn't take those funds. Now you can kind of start deciding what you want to do with those funds as far as investing goes. If you go to a new employer and they have a 401k plan, a lot of employers, not all of them, a lot of employers may allow you to roll over that current one or from your former employer into your new plan as well. And then the other one is you could choose to leave it with your employer, okay? Once again, there's pros and cons to doing each one of them. A lot of my clients I've seen, typically they like to take possession of that and move it into their own IRA just because they have more control over it. Work-sponsored plans typically have very few options as far as investments can go. Once you take it over possession of it, you put it in your own IRA, then you kind of decide what you want to do with it. If you want stocks, mutual funds, bonds, whatever you want to do with it. So a little bit more flexibility. Selecting investments that match your risk tolerance. Diversification. What's diversification mean? Anybody want to jump in on that?
Don't put all your eggs in one basket.
Very good.
There you go.
What does that mean? Put that into an investment analogy.
Okay, so if you have the option to invest in, let's say, bonds, large U.S. equity, housing, mutual funds, just the vast amount of majority of things that are out there, if you put everything in the mutual funds and then mutual funds tanks, you've lost everything. So essentially what it means is don't be afraid to diversify your investments, of course. Do your research, of course, talk to an advisor, of course, go meet with your banker if you have questions so that they can get you over to the proper reference so that they can give you the proper information that you're looking for in regards to investments. Of course, you don't want to put everything into one sole thing, diversify it a little bit, maybe invest in maybe 4 to 5 different categories just in case one does go bad. You still have the rest to fall on, of course. It's just to make sure that you aren't putting too much risk on yourself at the end of the day.
So diversify your investment portfolio. So that can look a few different ways. So one of which is if you're investing in stocks, right? You buy some bonds, put that in there too. So if the stock market's down, typically the reverse happens. Bonds are up. If bonds are down, typically stocks are up. So kind of, weighing your risk there. The other thing is if you're just looking at, hey, investing in the stock market, well, you don't want to invest in all your money in the same sector. So that would mean like right now, AI is the big boom, the tech sector. You put all your money in tech stocks and all of a sudden the tech sector goes down. Well, yours is going to go a lot lower. Whereas if you were invested in the tech market, tech zone, you're in pharmaceuticals, you're in just everyday, retail, right? Invest over different sectors, right? You're less likely to experience those big losses. Okay. So diversification is huge when it comes to investing. It also could mean that, hey, you got some money in the stock market, but I'm going to put some money into real estate. Right.
Correct.
So diversifying over different sectors as well.
Mark sat on here and talked about gold and silver. Another option that people forget. Yeah, there you go.
Commodities. Okay. So lastly, maintain consistency. What does that mean? So if you do start investing, let's say take somebody, young person, they have this extra money and they're putting it in there. What's a good way for them to be disciplined in continuing to make that happen?
Well, if they have a bank account, getting stuff set up on, automatic pay, things of that nature. So that way, you're not missing out. Because again, if you're not consistent, if you can have something, if you're watching, you can miss out on a game because you didn't get to the bank, whatnot, or you got busy doing something. So I'd say automatic pay, or like we talk all the time now, stuff on your phone that you can do. Just being consistent.
We've talked about it as a budgeting tool on the show numerous times of, hey, set up an auto or split direct deposit. Right?
Yeah.
Paycheck comes in, say at $50 every paycheck goes into your savings account, start building. Same thing here. If you know that you can budget for $200 every paycheck, we'll have that automatically come out of your paycheck into your brokerage account each pay cycle, if possible. That way you're more disciplined. You're consistently investing rather than, I got some money there now. I'm going to take this $200 and go buy a new pair of shoes, right?
Yeah.
Be consistent with what you're doing. And then also monitor and adjust. What does that mean? That kind of looks like if what you invest in today, does that mean that's the best investment for you a year from now?
Nope.
No. Right? So reviewing your best investments consistently, seeing if it still aligns with what your goals are. So as we just talked about, young versus old when it comes to investing, that's really what it is. As you get older, and if you do have a financial advisor, that's usually one of the biggest things that they do is sit down with you periodically, yearly, to see how your goals have changed so they can adjust your investments properly. Yeah.
Now, like you said, as far as life circumstances, but there's a thin line because almost like what you talk about when you're investing, if you're watching, is it something you're gonna pull out because you don't like the way the stock is doing, or are you in it for the long haul? But I get it, like what you're talking about as far as the personal demographics, and financial advisors will often send you out and you do your periodic check-ins just to see, where you're at and what you, as you said, if your goals are still aligning.
So I'm so glad you mentioned that when it comes to selling when the stock's down, right? Because that's usually where most people end up losing money. Stocks go up, stocks go down. We're talking about your risk tolerance as well. If you can't handle that, that's probably not the right investment for you. Because if you're somebody who's going to panic when the stock goes down and sell, you've realized your loss. If you don't sell, you haven't lost yet. It can go back up, but once you sell, you've taken a loss on it. Right. So really, it's that volatility of the stock market, if you can handle it or not for the right investment. But that's not always the case. If you buy a stock, you should be buying it for a reason. You believe in the company, you believe in where they're going, the direction, the profits, and all that stuff. To where if that stock, something changes within their business model, right? If AI right now is the huge thing, and a year from now that bubble bursts, does it make sense to still stay in it? Maybe, maybe not, right? So you gotta kind of always weigh that option. So it's not always the same advice each time that you got to stay in a stock. If you think that your belief in that stock is gone and it's based upon business, then great. If it's just based upon emotion because it's going up and down, I wouldn't sell it, right? So there's different things to think about when you're doing that. So that's kind of investing for beginners to kind of decide when you want to invest and how to start. But let's talk about different types of investing. So we mentioned stocks. Stocks are equities. You're actually, when you're buying a stock, like let's say it's Apple, for example, you're buying a share of the company, right?
Yes, sir.
You're a partial owner in the business by buying the stocks. When you own a stock, you profit when? Your question?
You said, huh?
When do you profit from a stock?
Oh, when it's up.
When it's up.
Correct.
Yeah. The
Period.
stock goes up, you profit. When the stock goes down, you lose, right? So profiting from stocks has happened when as the value of it goes up and down. Sometimes that value is going up based upon business, right? As the profits go up. Other times it's done based upon news. We saw that earlier this year when there was a change in the presidency and some of the things were happening. The stock market was down and everybody was panicking and it's crashing. And Tesla's a perfect example of that. People were panicking, talking about how Tesla would never recover from that. 2 months later, it's higher than it's ever been before.
Correct. That's what I was gonna say. When you said when it's up, but when you're down, you're losing short term, maybe not long term, but short term. So,
But the key to that was that dip in there, that big dip that happened that people were panicking on selling, had nothing to do with their business.
no.
Right? Had to do with media, had to do with other stuff out there, politics.
Media, national disasters. You see all that stuff that kind of affect the stock market.
Yep. So that's where it kind of really comes into play on understanding why the stock's down and whether you still believe in it or not or should hold it. Bonds. Anybody want to tackle bonds?
Terrence hit on that earlier.
Yeah,
What's a bond?
So a bond is a loan made to a government or corporation. This year promises to pay you interest over a set period and repay the principal amount when the bond matures. It is generally considered less risky than stocks, offering more predictable, steady income stream. And pretty much how you make money on that is you receive regular interest payments and your initial investment back at maturity. And with that being said, I actually did redeem some savings bonds yesterday, actually. Pretty much how it works is you get it almost looks like money. It's like a bond that has a face value ranging from like $25, I think, all the way up to about $10,000, if I am correct. Typically, what that does is you hold on to that for roughly, I do believe, is it 20 or 30 years?
Depends on the bond, but if we're talking about double E, which is the most common,
Double
it's
E, yep.
30 years.
Yep.
Yeah.
So pretty much you hold on to the bond for about 30 years and you accrue interest on that over that 30 years. Once it matures over that 30 years, you take it into your financial institution, you pretty much redeem it. Then they pay you the interest over what that face amount was. Again, safe, secure, for a fact that the value of the bond is saved, it's legitimate, there's no risk associated with it. Unless you lose the bond or something like that.
It's a fixed income? Is that
Fixed income?
is a bond? Fixed income?
Yeah.
Okay.
I mean, essentially, it's. I think with the double E's, you're buying it at half the face value of it, and then at 30 years it matures. It's the full face value is what you'll get back, but you've made the interest during that 30 years, whatever the interest rate is that bond's paying on there. So that used to be a real popular method for older folks back in the day.
Correct.
Interest, and they were scared of the stock market because of the Great Depression and all that stuff that happened there. You don't see people as much today doing them, but they are still out there and they're still available for you. Other types of bonds are, when communities want to raise money for school projects, things like that, they might issue bonds, right? Asking people for people give them money and they're paying interest over a set period of time for it. So basically, the community is loaning the money by buying these bonds, right, to do what they want. Cash equivalents. So cash equivalents would mean something like they're low risk investments that protect your principal and offer easy access to your money. So i.e. savings accounts. Very, 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 very low risk, very, very, very low return on it, right? Low risk, low return. CDs, same thing. CDs, if you want something safe that, money's going to be guaranteed 5 months, 10 months, 12 months, whatever that may be for a, let's say 4% rate, not a bad place to put it to watch your money grow. That's something of a short-term investment option for somebody who's looking to buy a house. If I can make 4% of my money, putting it in a CD, I'm not going to buy a house for 2 years anyways. That's a way to grow your money a little bit, not necessarily putting in the stock market where it can go up and down. Or money markets as well, which money markets are kind of like a hybrid checking savings account. Really, most people think of them just in terms of it as a savings account. Usually they just pay a little bit higher interest than what a traditional savings account would. Mutual funds. Anybody want to take mutual funds, or you want me to take that?
You can take me.
Okay. So mutual funds are a pool of money from investors to buy a diversified collection of investments managed either actively or passively. So a good way to think about this is mutual funds, instead of buying Apple, instead of buying Google, right? A mutual fund holds multiple companies in it, and you're not buying one share of each one of those stocks. You're buying a share of the mutual fund, so you're actually having a fraction of a share of those companies. Okay. Can anybody think of why somebody would buy a mutual fund rather than a stock? Knowing that information?
Does it have to do with anything about diversification?
Exactly. Exactly. Your eggs are not all in one basket. If you got all your money in Apple and Apple goes down, well, you're guaranteed to lose.
For example, Target.
Target.
Yeah.
Yep. But if you got in a mutual fund, you have multiple companies in there that you own fractional shares of that. So if one's up, the other one's maybe down, right? Maybe up, down. So your return is probably going to be not as great, but your risk isn't as great either. So that's a lot of times why people will invest in mutual funds. Managed actively or passively, or a lot of times those will have fund managers who are day to day, month to month. They're actively doing it. If they see a company they no longer believe in, that they don't believe is going to do it, they're going to take that company out. They're going to put another company in there. Okay. You, as the person owning a mutual fund, don't necessarily know or realize the difference. You're just kind of counting on these people, that mutual fund manager, to do what's in the best interest of the mutual fund to keep growing the price. Okay. Due to time, I'm going to kind of skip a couple of these. Exchange traded funds, ETFs, people know them as. Index funds are kind of like the S&P 500. So S&P 500 is a mutual fund comprised of the top 500 companies in the U.S. That's usually the benchmark that most financial advisors will tell you, like, hey, if you, history has shown us, you put money in the S&P and just leave it there, it's going to grow, right? Because you got the top 500 companies there. Sometimes they're up, sometimes they're down. But once again, as a whole, those 500 companies keep growing and growing and growing. So the safest kind of investment from that standpoint is just put it in an index fund and watch the index grow. Okay. But then we got alternative investments. What would be some alternative investments? So getting away from stocks and mutual funds,
Real estate,
people.
real estate, gold, silver, gems, things that we know for a fact are already there, existing still. Things that have already held value from centuries and centuries ago.
Cryptocurrency.
Crypto's a big one now. So you mentioned young people, right?
Yeah.
That's the big thing with young people. And I don't know if you guys have realized it or not, but they all want to invest in crypto. Don't know enough about it to talk about it educated. However, just to point out, cryptocurrencies right now, there's really nothing there backing it. Right? When I say that is what there's no profits from a company making it grow. It's really belief and gambling on Bitcoin is going to be the new currency of the future, right?
Yeah.
But it could very well not be. But that's why it's growing in value, is because of the belief that it's going to be that. But there's no profits from a company. There's no numbers to back any of this up. Where a stock, you can see a profit and loss from a company. You can see what direction they're going, what they're selling, what they're doing as a business, to kind of get more belief behind it. There's something of value there. But cryptocurrencies are huge with the young. So if that's what it takes for somebody to get started, investing, great way to do it. And also teach some lessons if you lose on it. But cryptocurrencies, private equities, investing in other businesses. We mentioned commodities, which are gold and silver. Mark had an interesting point I think he mentioned on the show, is previously that used to be a hedge against inflation, right?
Correct. Yep.
But in today's world, gold and silver, especially with tech the way it is, it's not really used as a hedge of inflation anymore. Gold is being used in a lot of the products. So when we're talking about like these chips that are being manufactured, all this stuff that goes into AI technology, gold is physically being used in there. Therefore, people have to buy it. They have to buy it to use within the companies. Therefore, it's going to go up in price, right? Because there's only so much of that stuff around. Right.
Yes,
that was
sir.
Mark. He was mentioned on the show.
Yeah, he did.
Yeah.
No question. Yes, he did.
So those are just kind of some stocks, bonds. We talked savings, cash equivalents, funds, and investment alternatives for you. Just to kind of give you some insight before we get out of here, some numbers when it comes to some of the major stocks we know. Amazon, December 1st, 2010, it was at $9 a share. Okay. 15 years later, $233 a share, right? If you would have invested that, and we're not even talking about decades ago, just one decade, maybe decade and a half. But Amazon seems like I was working, right? 2010. I could have absolutely been investing in Amazon at the time. I knew what Amazon was at the time. I should have bought some for $9 a share. Make a lot of money since then. Google, same time period, 2010, $14.79 a share. It's now worth $320 a share. Okay. Disclaimer: these numbers do fluctuate daily; they go up and down. Apple, 2010, $12.61 a share, $278 a share now. Facebook was a huge one. I remember when that became what they call an IPO, initial public offering, the first time it became available for the public to buy shares of the company. It was highly publicized. People wanted it. It went down right away. People were panicking, getting out of it. Probably, I'm just guessing this, but I think it was like 6 months later it started going up and has done nothing but that since. Facebook was $31 a share. It is now as of December 1st, it was $647 a share for it. So those are just kind of some things. Bitcoin, to touch on the cryptocurrency, numbers I got was 2010, 39 cents per share or per Bitcoin. That jumped in 2016 to $453 per Bitcoin. Anybody want to guess what it was in December without looking at that? Anybody know what Bitcoin current prices are today?
Isn't it like
87,000. As of December 1st, $87,109 per Bitcoin. Okay. Once again, 2016 was $453.
Okay.
So this is just meant to point those out as to show you what kind of growth you can get from investing. So whether that's in stocks, mutual funds, savings account, whatever it is, investing is the way to go.
Gotcha. You gave us the here and now, or the then and now. So where we going now? Where's our Amazon now? Where should we put our money at?
Where should we put it at now?
Yeah.
I'm not giving advice on the show.
Hey,
Yeah.
you did-
So once again, that's for, if you're interested in investing, that's for kind of you to figure out where we started at, is finding out what your budget is, what your risk tolerance is, what kind of money you have to be able to invest, and then kind of decide what's there. Once again, getting advice from a financial advisor can help also. But really the difference and the purpose of this conversation was not everybody's necessarily, in my opinion, ready for a financial advisor. If you only got $1,000, $2,000 to do, an investment advisor probably isn't investing that money for you, right?
Correct. Yes, sir.
Difference is they're charging you fees for it. So they're going to tell you right up front, if you give me $1,000 to invest, the fees you're paying me are going to eat up whatever profits you make, right? Doesn't make much sense. If you want me to give you maybe some advice on something, of where to go, maybe talk to them a little bit about this, educate them a little bit, they might do that. But this is really investing 101 for beginners, whether it be age-wise or just, I don't know anything about investing. Where do I start? Right.
Gotcha.
So some basic information. So, anything to add before we get out of here?
last thing I will say again, talk to your bankers, go to your financial institutions. If this is a lot of information, investing is not a simple or easy thing to understand. There are a number of individuals at your financial institution that are willing and ready to give you as much information to pretty much guide you on investing if it's something that you're ready for. And I encourage you to go speak with them.
I echo that, and I just say, young people out there, understand compound interest. If you want to understand how your money can grow, and when I talk about the time and where your funds could be, compound interest, understand that.
Yeah. And once again, this topic of this conversation show was not necessarily for financial advice, but more basic information on investing, where to start. A lot of times, if you're looking to invest, your bank, those investing apps that you have, the different investment brokerages, they'll have customer service numbers that if you have questions like this or need some direction, they may be able to help you with that prior to you knowing what kind of account to open, or what kind of investments that you may look at doing for it. So,
Alrighty.
gentlemen, good conversation here to take us out for the rest of the year. I think we'll be back in February. I think we take January off, right?
Correct. Yes, sir.
Yeah, we'll be off until then. But I want to say Merry Christmas. It's been a pleasure doing the show with you guys this year. Can't
Merry
wait to come back
Christmas.
in February as well. And shout out to the whole Our Neutral Voices team, 6th District Coalition as well, for everything that you're doing in the community this year and forward as well. Yep. So till February, we are Our Neutral Voices. Peace.